Quarters, we now have the management joining us. Kaleeswaran Arunachalam, Group CFO and Head of Strategy at Crompton Greaves Consumer Electricals is now joining us. Thank you so much for taking your time out and joining us. While revenue growth was flat in the quarter gone by, EBITDA and PAT, as I mentioned, have seen declines. If you can tell us what led to this degrowth in the quarter gone by as far as margins are concerned and EBITDA is concerned, and how do you expect profitability trend to shape up in the second half?
Revenue growth has been flat, but it is also backed by an underlying volume growth of 3%, aided by strong performances in Butterfly, Lighting, and in Crompton Kitchen. Fans and probably the summer categories had a poor season, mainly due to the inclement weather continuing, which also had an impact on margins because these being high gross margin categories. Outside that, as you would know, as part of Crompton 2.0, we have also been taking many transformation initiatives. One of them was on supply chain, where we have now repurposed our Baroda plant from a single PL to multiple business units, where we had to incur about, say, 21 crores of cost, which is an exceptional one-off. Keeping this aside, I think there has been commodity inflation pressure in fans. We expect that to be passed through via pricing and cost actions effective November onwards. So from a segment perspective, our margin trajectory is on track in Butterfly and in Lighting. Within ECD, the mix of summer categories being lower impacted the margin due to mix. But otherwise, whatever is the commodity inflation that we are seeing, we expect that to be passed back in the coming quarter and this quarter.
All right, so that's as far as revenue and margin outlook is concerned, but your ECD segment also faced margin pressure in the quarter gone by, while Lighting saw a strong rebound. If you can tell us what's driving recovery as far as the Lighting segment is concerned, and how do you plan to stabilize margins for your ECD segment?
Lighting, it's been a journey that we have undertaken for the last 6 quarters. Some of the key levers being one, getting the ceiling lights, which is premium part of our portfolio, share of business to go up significantly. Ceiling lights operates at a higher gross margin compared to other categories. Second is we have also worked on cost initiatives. Unnati, which is a flagship project, where we look at fit for purpose products, helps us to improve gross margin. So combined with improved mix in ceiling, improved overall performance of B2C, which is aided by a very strong team's volume growth, coupled with cost initiatives have helped us to get lighting margin to historic high. We have always been and continue to be a margin leader in ECD. I'm glad to say that now we have reached that stage in Lighting also in this quarter. Coming back to ECD, as we said, there are 3 components driving the margin right now. One is the commodity inflation that we talked about. We are expecting that to get restored via price actions. First round of price actions has already been rolled out in November for about 1.5%. We expect a few more cost initiatives to also come in, which will help us to improve the margin. Second is mix. This is largely due to, as I talked about earlier, some of our categories like air coolers, table, pedestal, wall fans, etc. had a poor season due to inclement weather, which are high gross margin categories for us. And as we expect the mix to normalize, the margin should also come back.
All right, so you expect the mix to normalize, and with that, margin should also rebound in the second half. But Mr. Arunachalam, what's the roadmap for scaling your solar vertical to the stated 2,000 crore revenue target that you've given for the next 18 to 24 months? What will the roadmap be for solar segment, and any other major order that is already in the pipeline and that you're working on?
Solar, we are working on 2 trajectories. Trajectory 1 is solar pumps, and the next trajectory is on solar rooftop. Currently, as we called out, we have an order book of about 750 crores that needs to be executed over the next 6 to 12 months. The way we are looking at this is going to be a B2C franchisee. Even in the case of solar pump, it is a farmer who decides the brand. The farmer chooses Crompton, and as you would know, it took many decades for Crompton to build a 250 crore business in agri pumps, which we have done it in less than 2 years in solar pumps. We expect solar pumps to replace agri pumps as a market over a period of time, and we are accelerating our journey towards that. As far as solar rooftops are concerned, right now we have obtained orders from Telangana and Andhra. This is only the beginning. We are also opening up a large B2C franchisee, where we'll be tapping up our existing distributor dealer network to reach out to consumer households and install. Few target states have been identified, which we expect can give us early wins to scale up solar rooftop. So, in a summary, we have an order pipeline which is about 750 crores that needs to be executed. And as we speak, we are building in a B2C franchisee, and we are also evaluating other options and tenders wherever we think the unit economics are strong. We are operating in this business because the margins are similar to the overall Crompton EBIT margins. The ROC return ratios are very high, and we also believe Crompton as a household name that has been there for 85 years. People know that many of us have lived with Crompton, and that gives us a right to win. On scale, when we move towards this 2,000 crore revenue target in the next 18 to 24 months, we also expect supply chain and technology benefits to kick in due to the operating leverage plus the scale at which we would be operating.
Understood. So that's as far as your outlook for order book position is concerned, but you've also taken an exceptional loss of about 21 crores for restructuring Baroda plant into a multi-business facility. If you can take us through the new product lines that you're venturing into and any capacities that are being added at this particular plant of yours?
Initially, if you look at it, Baroda historically was a lighting plant, and we had capacity underutilization with high fixed cost in the lighting ecosystem in Baroda. So we have to part away with that high fixed cost and also ensure the capacity utilization for the size of the plant it is gets optimized, which is where we redrew the plants. Baroda, which used to be a lighting plant, today it does not only restrict to lighting, it now supplies to fans. We make our PCB for BLDC fans out there. Large kitchen, which is a growing business for us, our chimneys and hobs are also getting assembled in Baroda. As we speak, we have also gotten a world-class validation lab that has been established in the Baroda plant just about a month back. And we are also in the process of consolidating our national spares network under Baroda. So from what used to be a single PL, it's now going to be a multi-business facility. This restructuring has also helped us to significantly reduce the fixed cost of Baroda operations and expect operating leverage to kick in as we speak from Q4 onwards. We expect this to pay us back in about less than 2 years towards the spend of 21 crores that we have incurred.
All right, so operational efficiency is likely to kick in from the fourth quarter of this fiscal. That's the word coming in. Mr. Arunachalam, thank you so much for taking your time out and joining us understand and helping us understand what the outlook is for the next quarter.